It's been said that the trading holy grail does not exist. While that's true to a large extent, it still is equally correct that not all trading roads lead to making performance compromises between risk and reward. What if you could get your cake and eat it too? To illustrate that, and before we focus on trade level countermeasures, today we're going to concentrate on an exploit that occurs at the portfolio level. Call it a mathematical quirk, this demonstrable phenomenon is probably the most surefire way to lower directional volatility without sacrificing returns as you assemble your systematic portfolio. So let's roll up our sleeves and I'll see you on the other side. In order to understand how to practically push the walls of traditionally expected reward to risk ratios, we have to understand first the theory that supposedly binds the universe of possibilities. This is a representation of what is called the efficient frontier. It is part of the modern portfolio theory or MPT and was introduced in 1952 by Harry and for which he was awarded the Nobel Prize in Economic Sciences in 1990. Here's the gist of it. Given an underlying subset of assets such as stocks, bonds, commodities, etc., what this efficient frontier describes is the universe of achievable best portfolios, with best portfolios being defined as those combinations north of the demarcation line that maximize the return to risk ratio for each given level of risk or return. Among these best portfolios, we can also find these best of the best optimal portfolios positioned right on the efficient frontier at the top. By looking at this figure, it's pretty easy to see how, for a given level of risk for example, any combination south of the best portfolio is necessarily suboptimal because it would only yield a lower return. Pretty straightforward. Now let's add one more twist to the MPT theory. Let's introduce this line called the capital market line that represents all of those theoretical portfolios that maximize return and risk. So quite evidently, the tangential point of the efficient frontier and the capital market line is by definition where achievable meets theoretical, meaning that this point is de facto the best overall achievable portfolio mix with the highest Sharpe or risk to reward ratio. But enough with the theory. Now you understand it, you would assume that diversification is expected to be the core driver of risk reduction, but that's not the case. Unlike the don't put all your eggs in the same basket saying goes, diversification is barely scratching the surface of what is required to optimize risk management. Let me explain to you what is. Modern portfolio theory does indeed do some preliminary work on efficient diversification by making sure that the aggregated covariance of those assets included within the portfolio nets out to something as close to zero as possible, implying by extension that portfolio returns would not be dependent upon market direction. While this sounds good in itself, the MPT, like most academic work, was born in a peer-reviewed theoretical vacuum from non-traders that have never actually invested actively for most. If you need an illustration of that fact on a larger scale and you are curious about how acclaimed academics do perform trading for real, I would suggest that you look into the story of long-term capital management that resulted in the $3.7 billion debacle of 1998. Here's the issue with the MPT assumption. Whereas targeting very low cross-correlation is indeed the solution, the main tenet on which rests the MPT model is the supposed existence of, if not static, at least sufficiently stable cross-correlation between assets. So stable, in fact, that it could be passively managed. Well, here's the rub. Markets quite radically disagree with that assessment, to say the least. Assuming stable long-term correlations is obviously silly because investors are irrational in the short term and can warp the traditional correlation landscape for longer than your portfolio can remain solvent. It can take the form, for example, of the crowd chasing yield regardless of risk given a sufficiently incentivizing financial context, such as a low or negative interest rate environment, for example. To add insult to injury, cross-asset correlation is even more unstable in times of market panic, while most assets tend to become synchronistically correlated at the very moment where you would need decorrelation to kick in. Talk about irony. Just look at what happened to stocks and bonds in March 2020. Does it look to you that bond decorrelation came to the rescue? That's my point. Using what is called mean variance optimization based on historical data boils down to building a trading strategy using statistics. And it is, as was repeated many times on this channel, a recipe for disaster. This native MPT investment model is what binds the comprehension of risk management for most CFAs and traditional asset managers, effectively turning their diversification into what is most commonly condescendingly referred to as deworsification. The first takeaway here is that the efficiency of risk management using a portfolio of assets is never a function of the number of assets held within that portfolio. In other words, holding a gazillion different stocks across various sectors, for example, just for the sake of it, does not guarantee decorrelation and risk reduction, simply because, and this is the second takeaway, correlation coefficients not only vary over time, they also tend to line up during a market crash. This very flaw regarding asset decorrelation is where the theory lacks, and where algorithmic trading steps in to fill the gap. The reason for the existence of portfolios of systems is to dynamically harness the reality of correlation, a tough reality where correlation coefficients are never stable. While recognizing this phenomenon complicates the rosy theoretical picture painted by MPT, it also at the same time opens a much greater potential for improving your overall risk-adjusted performance. Your job as an algorithmic trader should not be to focus on diversification in terms of breadth of asset exposure, but rather on maximum algorithmic decorrelation. This should be accomplished by making use of the least diversification possible in order to not leave historical cross-asset relationships blur out how good of a job you're doing from a purely rule-based systematic standpoint. And the more mathematically relevant your systems, the easier it gets to achieve that goal by creating derivations and combinations of your trading systems. Intelligent system mixing will not only allow your synthetic portfolio to stand on the efficient frontier, but also displace and distort, or in that case steepen, the entire universe of achievable portfolios by getting as close as possible to the tangential capital market line described earlier. Blending your trading systems should result in a portfolio that is more efficient on a risk-adjusted basis than the sum of its parts. And this is precisely where the trading free lunch comes in, through dynamic decorrelation. Your choice of systems should be able to achieve it two ways. Strategically first, by switching broadly between systematic logic and targeted asset class, and tactically second, by dialing each individual system's algorithmic logic. If you followed the guidelines presented in the earlier videos of this series, getting there should not involve any guesswork. The reason being that because your systems were purposely built mathematically as opposed to by using brute force statistics, you would know without any hesitation what price motion each one captures, precisely what parameter to act upon in order to modify the system's reward to risk profile, and what trading logic is the most susceptible to complement another one so as to achieve maximum decorrelation. The task of building your efficient portfolio then becomes nothing more than a straightforward game of Lego, and it can be done both horizontally and vertically. Here's the difference. First, horizontal decorrelation means that decorrelation is reached by stacking different systems. The variation criteria can be done two ways. The first one is through the choice of underlying instruments such as, for example, a particular asset class, a given investment universe or an industrial sector, or a geographical region, etc. The second way to create horizontal decorrelation is by stacking systems with opposing algorithmic logic. For example, long and short, mean reversion versus momentum, pair trading divergence versus convergence, price directional versus volatility arbitrage, premium selling versus buying, long-term versus intraday frequency, etc. You get the point. The goal is to stack different systems which individually generate positive expectancy, yet produce a blended portfolio of systems which generates an expectancy that's higher than the average of its underlying individual systems. Let me show you a real-life example to illustrate the mathematical reality of what I'm talking about. Here are two of my systems. The one on the left depicts a variation of alpha which deals with broad asset class ETFs such as equities, bonds, commodities, and so on. The second one is a directional system covering high volatility stocks pertaining exclusively to the Nasdaq Composite Index. Two very different systems in both purpose and design. Here are the individual performance properties of each one. Obviously, the stock system has a much higher CAGR than the ETF system, which itself is much more stable than the Nasdaq system. No surprise here. My goal now is to create a mini 75-25 portfolio including both, and see what the breeding generates as far as risk-adjusted performance. Here's how the child portfolio looks, and here are its stats. As you can see, it's pretty obvious that the decorrelation magic just played out. Despite the 75% allocation tilt to the ETF system, we are now retaining a significant portion of the ETF system stability while collecting a drastically improved CAGR from the relatively unstable Nasdaq system. And if we still wanted to target the same CAGR as the Nasdaq system, we could easily solve for that by making use of some leverage, and we would still not take as much risk as if we were to trade the Nasdaq system alone. Either way, the normalized quality of this blended portfolio is uniformly superior to either one of its parent systems taken individually. The second way to achieve decorrelation is done vertically, by deriving variations of the same trading systems. If your system was properly designed in such a way that it verifies the condition of parametric coherence, which was described in detail in this video, then the task of extrapolating different, yet equally viable breeds of the same system should be fairly easy. Basically, proper algorithmic design should empower you with the knowledge of what parameter to dial in or out in order to get the desired change in risk-reward profile, with consistent behavior change of that profile along the value scale of that parameter. Achieving vertical decorrelation can also be done by seeking asynchronous behaviors depending on the weights attributed to each parametric input. For example, you could have variations of the same system trading long and short simultaneously, or being more or less responsive to inertia by responding in a mean reverting or momentum-driven fashion, or by seeking different pools of volatility subgroups within the same investment universe. This aspect is one more example of why grounding system design in math is so important, because it offers a multitude of avenues to create gradients of the same system and achieve that vertical decorrelation without relying on optimization or having to build an entirely new system altogether. Let's go over a concrete example once again. Let's take 4 variations of this equity trading system that only trades the most highly liquid stocks of the S&P 100 and the Nasdaq 100 indices. And here are their individual stats. Clearly, some variations are much more stable and risk-averse than the others. Just like we did it with horizontal decorrelation, our job now is to blend these so that their combination beats their average. Let's see what a 30-20-30-20 mix would look like. Once more, the decorrelation effect is apparent, especially when it comes to risk-adjusted metrics such as the Sharpe ratio. This result implies that we are effectively shifting the entire efficient frontier of the portfolio itself, as portrayed by the blended combo being greater than the sum of its parts. And as an added bonus, we can even play with the weightings attributed to each system in order to make the portfolio navigate over that steeper, more optimal efficient frontier that is now much closer to the capital market line. The bottom line is this. It works, like clockwork, with the only caveat of course that such a quantitative phenomenon can only be reliably reproduced should your systems be sound from a mathematical standpoint first. Trying to achieve the same with statistically designed systems will either not work or will require a lot of parametric tinkering and curve fitting that will almost always lead the portfolio to misbehave and actually become worse than the average of its parts once traded live. But the peace of mind that comes with risk management being taken care of at the root of your portfolio construction, as opposed to solely being carried out on a trade-by-trade basis, is not only a feature that procures a much safer and more reliable way to protect your capital, it also fosters your emotional longevity in this field by knowing firmly that your portfolio is not relying on unstable past correlations to manage risk, but rather deals with them dynamically through a stack of systems and a blend of system variations that blur and cancel out drastic changes without sacrificing risk-adjusted return. If that sounds like a better idea than leaving your stop order like a sitting duck on your broker's order book, and if your idea of risk management has been broadened in the past 10 minutes, then this video was most certainly successful. We're already miles away from retail land and their bro science that leave you vulnerable to those who know what they're doing. Or just put your stop order below that last supply-demand support pin bar 38% fib retracement level, bro. Right. Unlike price action-based stop losses, dynamic decorrelation can be tested and it can be dialed in or out at will, and it works without damaging your reward to risk ratio. In fact, it improves it. With that said, portfolio level risk management is only the first part of the picture. In Series 3, we will move from macro techniques to delve into micro considerations, and we'll look into how a single system or a single trade can best manage risk on their own, and how putting it all together between portfolio, system, and trade level risk management together contributes to help you build an ironclad trading solution that takes care of volatility at every stage of the trading life cycle. There's more to come and a method to the madness, so make sure to subscribe not to miss the knowledge drops, watch these episodes in order, and give it a nudge for the YouTube algorithm to propagate trading content that does its best to take you beyond the candlestick. I'll see you in the next video.